Many people think that when they left the UK, they leave behind HMRC. However, here is the truth. Even though you're living in New York, Sydney, or in Dubai, you are classed as UK non-resident. However, in some cases, you still need to pay a UK tax. Yes, you heard it right. Even though if you're UK non-resident, you still need to pay income tax on some assets. Non-resident status is decided by statutory residency test. The vague and very general explanation is if you spend fewer than 16 days in the UK or you work full-time abroad and spend under 91 days here, you are usually non-resident. It's all about days and ties, but of course you must need to consult with tax accountant to get it right. But I will record a separate video on statutory residency test and how does it work in your specific case, or how you can work it out whether you are a UK resident or non-tax resident. As a non-UK resident, you don't need to pay income tax on your worldwide assets, which means if you are living in the UK, then you need to pay income tax on your worldwide assets. However, if you are treated as a UK non-resident, then you only need to pay income tax on your UK based assets, which includes if you have a trading business here in the UK, then you need to pay tax on profits which are generating from the UK trading business. If you have a property in the UK, any rental income you are generating from that property, you need to pay income tax on that. Even though if you are a non-tax resident and you are performing your employment duties here in the UK, then you need to pay employment tax on duties performed within the UK. For UK state pension, dividends, and interest, rules are quite strict and they are kind of like nitty-gritty of income legislation. Sometimes you do need to pay tax on these sources of income, but for now I leave them because the rules are quite strict and I don't want you to confuse. And of course, for pension, interest, and dividends, you also need to look into specific country related treaties. Now the second question people ask is what if they have a property here in the UK and they sell that property? You need to pay a capital gain tax on all your UK based assets including your property. If you have a property in the UK and then you sell that property, you need to report that gain within 60 days and you need to pay a capital gain tax on your property gain within 60 days. However, the good news is there is a double tax agreement or there's a double tax relief. Let's say if you are living in France and you have a property here in the UK, you pay a capital gain tax here in the UK. UK have a double tax treaty with France, which means the property you sell here in the UK, you pay a tax on that. You can claim that tax back in France on your profits or whatever the treaty allow you to do that. So it means if you're living in the country which have a UK double tax treaty, then you could be able to claim a tax on your UK source income into your specific country. Now, the big question I always ask is claiming a personal allowance. This is one of the most important element in UK taxation. Each year you are eligible for £12,570 personal allowance, which means if your income is less than personal allowance, you do not need to pay any tax. However, as you are non-resident, then you need to check whether your country has a double tax treaty with the UK to claim personal allowance or not. On some occasions, you can claim personal allowance like if you are non-resident, however, you do have British passport, therefore on that basis you can claim personal allowance, but I am going to publish a separate video on it, so watch out. Therefore, here are few key takeaways which you can take from this video. Number one, track your number of days you spend in the UK. Number two, if you own a property in the UK and you let it out, then you must know that you need to pay a rental income tax on your property. Number 3 is if you sell a property in the UK, then you must know you need to pay a capital gain tax on that within 60 days. Number 4 is check your specific country legislations with the UK. If they do have a double tax treaty, then you might be able to claim a personal allowance on that basis. And as I always say that, please, please, please do share your experiences, do share your story. It might be the case someone might inspire your story and someone might learn something from your story which might change their lives. If you have any questions around personal loans, your residency, your non-residency, your rental, your CGT, please get in touch via email or LinkedIn and we will sort it out together. As always, hand ahead salute until the next video.